In one single trading day, a chip company almost nobody outside the semiconductor industry had ever heard of became more valuable than the bank that has run China's financial system for the last 3 decades. Its stock did not rise 10%. It did not rise 50%. It rose 466% in a single session. And by the end of that week, this company was worth more than 4 trillion yuan, making it the single most valuable listed company anywhere on mainland China. This is the story of CXMT, a memory chip maker from a city most Westerners couldn't find on a map, and why. Apple, the Pentagon, and Samsung are all suddenly watching it very, very closely. Here's why this actually matters to you, even if you've never bought a single share of Chinese stock in your life. Every AI chip on the planet, from NVIDIA's most expensive data center GPUs to Huawei's homegrown accelerators, needs one critical ingredient to actually function: high bandwidth memory. Without enough of it, even the fastest processor in the world becomes a very expensive paperweight sitting in a server rack. For years, that memory has been controlled by exactly 3 companies on Earth: Samsung, SK hynix, and Micron. 3 companies, 1 industry, and China locked almost entirely out of the club, despite being the world's largest electronics manufacturer. What just happened in Shanghai threatens to break that monopoly wide open, and the United States government does not currently know exactly what to do about it. This isn't a distant industrial story happening on the other side of the world with no bearing on your life. Memory chips sit inside literally every piece of technology you touch, and whoever controls the supply of them quietly controls a piece of the price tag on your next phone, your next laptop, and every AI subscription service that depends on data centers packed with this exact component. Let's rewind to understand who CXMT actually is, because this company's rise did not happen overnight, no matter how it looked on IPO day. Changshan Memory Technologies was founded in 2016 in Hefei, a mid-sized city in central China that most people outside the region had never heard mentioned in a business headline before this year. The company was built with heavy backing from the Chinese state, and its entire mission from day one was blunt and unapologetic: build a domestic Chinese alternative to Samsung, SK hynix, and Micron, so that Chinese phone makers, laptop makers, and eventually AI chip makers would never again have to depend entirely on foreign memory suppliers who could be cut off by a single policy decision in Washington or Seoul. For most of its existence, CXMT was a background player, quietly building fabs and expanding capacity, while barely making headlines outside of trade publications and semiconductor industry newsletters that only a handful of specialists actually read. It made conventional DRAM chips, the kind of memory found in ordinary laptops and smartphones, and it slowly chipped away at global market share. By last year, CXMT held roughly 7.67% of the entire global DRAM market, according to figures disclosed in its own IPO prospectus. That's not nothing. But it also wasn't enough to make Samsung, SK hynix, or Micron lose much sleep. It made CXMT the world's 4th largest DRAM producer, a distant 4th behind 3 companies that, combined, still controlled roughly 90% of the entire market. For years, that was the story. China had a domestic memory maker. It existed. It was growing slowly. Nobody outside the industry particularly cared. Then 2 things happened at almost exactly the same time, and together they turned CXMT from a niche industrial story into one of the biggest financial events in Asia this year. The first was an AI-driven memory shortage that nobody saw coming at this scale. As AI companies around the world scrambled to build bigger and bigger data centers, demand for memory chips exploded in a way the industry hadn't planned for. Every new AI model needs more memory. Every new data center needs more memory. And suddenly, there simply wasn't enough supply to go around. DRAM contract prices shot up somewhere between 93 and 98% in a single quarter earlier this year. Read that again. Prices for a component most people never think about nearly doubled in 3 months. Suddenly, a company that makes memory chips wasn't a boring industrial supplier anymore. It was sitting on top of one of the most valuable commodities in the global technology economy at exactly the moment global supply was tightest. The second thing was CXMT's decision to finally go public, and the timing could not have been more deliberate. On the day of its Shanghai debut, CXMT priced its shares at just 8.66 yuan, roughly equivalent to $1 American. The company raised 57.92 billion yuan, close to $8.6 billion US, making it the largest initial public offering anywhere in Asia so far this year. and the second largest domestic listing in Chinese stock market history, trailing only Agricultural Bank of China's massive listing back in 2010. Retail investors in China oversubscribed the offering by more than 212 times. 212 times. To put that number in perspective, for every single share that was actually available, there were 212 separate orders competing to buy it. And because less than 7% of the company's total shares were actually released to trade on day one, there was almost nothing available to soak up that overwhelming demand. Key result was, in hindsight, almost mathematically inevitable, even if almost nobody predicted the exact scale of what happened next. When trading opened, CXMT stock didn't just rise, it detonated. Shares surged 466% before the trading day was even over, closing with the company valued at roughly 3.3 trillion yuan. That single day of trading pushed CXMT past the Industrial and Commercial Bank of China, one of the largest, oldest, and most powerful financial institutions on the planet, to become the single most valuable listed company anywhere on mainland China's stock market. Analysts pointed out something remarkable. This marked the first time in the 35-year history of China's modern stock market that a semiconductor company had ever held that top spot. Not a bank, not a state energy giant, not a consumer brand every household in China recognizes. A memory chip maker most people outside the industry had never even heard of, a week earlier had, in a matter of hours, become more valuable than institutions that have anchored the Chinese economy for decades. And the surge didn't even stop there. By the following Friday, riding a broader rally across Chinese semiconductor stocks, CXMT's market capitalization had climbed even further, crossing 4 trillion yuan. There's also a detail about the trading mechanics themselves that explains why the surge was even mathematically possible in the first place. Under Shanghai's star market rules, newly listed shares are not subject to the usual daily price limits during their first 5 trading sessions. Normally, Chinese exchanges cap how much a stock can move in a single day to prevent exactly this kind of runaway spike. For CXMT's first week, that safety valve simply didn't exist. Combine that with a free float of less than 7% and an oversubscription rate above 200 times, and you had a stock with almost no available supply, an enormous wall of demand, and no regulatory speed bump to slow the collision between the two. Some analysts on financial television openly called it one of the most extreme first-day setups they had seen in years, and pointed out that CXMT wasn't even the first Chinese tech listing this year to produce numbers this dramatic. Semiconductor testing company Samite Instruments rose more than 800% on its own debut back in April, and chip designer More Threads gained over 400% in December. CXMT was simply the biggest name yet to ride that same wave, and by far the most strategically significant. That pattern matters, because it tells you this isn't just one company catching lightning in a bottle. It's a signal that Chinese retail investors have developed a very specific appetite. Pour overwhelming demand into any domestic chip company, positioned as a genuine alternative to Western semiconductor suppliers. Semiconductor self-sufficiency has become not just a national policy priority in Beijing, but a retail investing trend with its own momentum. Morningstar analysts noted that as artificial intelligence increasingly becomes framed as a matter of national security inside China, CXMT is positioned to be one of the primary beneficiaries of that framing, even if its underlying technology still lags the global leaders in raw capability. The market isn't necessarily betting that CXMT is already the best memory maker in the world. It's betting that Beijing needs CXMT to succeed, and will do whatever it takes to make sure that happens. Now here's where this story stops being just a stock market curiosity and starts becoming something with real geopolitical teeth. Roughly 1 month before this IPO, the United States Department of Defense added CXMT to its list of so-called Chinese military companies. This is not a symbolic gesture or a minor bureaucratic footnote. It is a formal designation the Pentagon uses to flag firms it believes are tied, directly or indirectly, to China's military-industrial complex. Companies that land on that list face real restrictions on their ability to do business with American entities, and in some cases, American investors face pressure, sometimes outright legal pressure, to divest from them entirely. So at the exact moment Washington was formally labeling CXMT a national security concern serious enough to warrant that designation, Chinese retail investors were throwing more than 200 times the available shares at it and Wall Street analysts were racing to publish notes explaining why this company suddenly mattered to global portfolios. And here is the detail that should genuinely stop you in your tracks. The kind of contradiction that almost sounds made up until you check the sourcing yourself. At the very same time the Pentagon was putting CXMT on a military watch list, reports emerged that Apple, the largest technology company in the world by market value, had begun testing CXMT's memory chips for devices sold inside China. Apple, the company that has spent the better part of 2 decades building an elaborate, meticulously audited global supply chain specifically engineered to avoid this exact kind of political exposure. The same Apple that pulls entire product lines out of countries over regulatory disputes far smaller than this one. Now reportedly running qualification tests on memory sourced from a company its own government just flagged as a military-linked risk. That is not a coincidence, and it is not Apple being careless. It is a sign of exactly how tight the global memory supply has become, and exactly how much leverage a company like CXMT can suddenly wield the moment it controls a resource everyone in the electronics industry desperately needs, regardless of which government is uncomfortable about it. But the real long-term stakes here have almost nothing to do with laptops or iPhones, and everything to do with artificial intelligence. This is the part most casual coverage of the CXMT story completely misses, because it requires understanding a technical detail buried a few layers beneath the headline stock numbers. China's most advanced domestically produced A chip, Huawei's Ascend 910C, is not primarily bottlenecked by raw computing power anymore. Huawei has already proven it can design competitive silicon. The real bottleneck is memory. Specifically, high-bandwidth memory, the ultra-fast stacked chips that sit physically right next to a processor and feed it data at the extreme speeds modern AI training actually requires. You can have the fastest engine in the world, but if the fuel line feeding it is too narrow, the car still doesn't go anywhere near its top speed. Right now, China's domestic high-bandwidth memory production, led almost entirely by CXMT, is still stuck roughly 2 full technology generations behind Samsung and SK Hynix. That gap is precisely why NVIDIA still holds a meaningful performance advantage inside the Chinese market, export controls or not. Chinese AI companies can buy every Huawei Ascend chip Huawei is willing to sell them. But if those chips can't be fed data fast enough, their real-world performance ceiling in large-scale AI training stays lower than raw compute numbers alone would suggest. This is the quiet, unglamorous constraint that has kept NVIDIA relevant inside China, even as Washington has tried repeatedly to cut NVIDIA out of that market entirely. CXMT is racing to close exactly that gap, and its IPO just handed the company one of the largest single war chests any Chinese chipmaker has ever received to do it. The company has reportedly stockpiled enough specialized manufacturing equipment to sustain production through 2026 and into 2027, largely by buying up machinery aggressively before tighter export restrictions could fully take effect and close that purchasing window for good. Industry analysts estimate CXMT could produce somewhere around 7 million high-bandwidth memory dies in 2026 alone. That's enough, in theory, to support roughly 600,000 AI accelerator chips built to a performance class comparable to NVIDIA's own H100 processor, assuming a reasonably typical yield rate. The company is publicly targeting viable high-bandwidth memory in the HBM3 class this year, with an even more advanced HBM3E generation targeted for 2027. If CXMT actually hits those targets on schedule, the performance ceiling on Huawei's Ascend chips rises substantially, and the competitive window American chip makers currently enjoy inside the Chinese market starts closing faster than most Western analysts have priced into their forecasts. This is exactly why US policy researchers have been sounding alarms that predate this IPO by months. Research groups focused specifically on export control policy have pointed out something that sounds almost unbelievable once you actually hear it stated plainly. Despite CXMT's central role in China's memory ambitions, the company was, until recently, notably absent from the US. Commerce Department's Entity List, which is the actual mechanism Washington uses to cut a foreign company off from American technology and equipment. In other words, policy analysts have openly admitted there is little strategic logic in restricting the export of finished high-bandwidth memory to China, while simultaneously continuing to allow the sale of the specialized manufacturing equipment that lets a company like CXMT build that memory domestically instead, generation by generation, gap by gap. That is the loophole CXMT has been racing through for the better part of 2 years, and its IPO just handed the company billions of fresh dollars to race through it even faster than before. So what does this mean for the 3 companies that used to have this entire market to themselves? Samsung, SK Hynix, and Micron have spent years enjoying relatively high margins on high bandwidth memory precisely because supply was so limited and so concentrated among just the 3 of them. A 4th serious competitor, backed by the full weight of the Chinese state and freshly funded with $8.6 billion, threatens to do to memory chips what Chinese manufacturers have already done to solar panels, batteries, and electric vehicles: flood the market, compress margins, and force established players to compete on price, in a category where they've grown used to competing almost entirely on capacity and yield. None of the big 3 has issued a panicked public statement, and none of them are likely to lose their footing overnight. But privately, supply chain analysts say this IPO is exactly the kind of moment that gets flagged in board meetings from Seoul to Boise. The kind of headline that quietly moves up the agenda on next quarter's strategy calls, even if nobody says the word threat out loud in the earnings release. And CXMT is very unlikely to remain alone in this position for long. Its Blockbuster debut has reportedly encouraged other major Chinese semiconductor companies to accelerate their own listing plans, including Yangtze Memory Technologies, China's leading maker of a different type of memory chip called NAND Flash, and the Kunlunxin chip division of Baidu, which designs its own AI accelerators. If CXMT's IPO performance holds up over the coming months rather than cooling off, expect a wave of similar listings from Chinese semiconductor companies over the next year, each one testing whether international capital markets are willing to keep pouring money into China's chip self-sufficiency push, despite the geopolitical baggage attached to nearly every name on that list. There's also a much more immediate practical angle here that affects anyone who has bought a laptop, a phone, or a graphics card recently, or is planning to soon. That 93 to 98% quarterly spike in DRAM prices isn't an abstract industry statistic sitting in a research report somewhere. It shows up directly in the cost of consumer electronics. Memory is one of the single biggest cost components inside almost every device you own that has a screen and a processor. When DRAM and high bandwidth memory get this expensive this fast, manufacturers either eat the cost themselves, which rarely happens for long, or they pass it straight through to consumers in the form of higher prices on next year's laptops, phones, and gaming PCs. A genuine 4th major supplier entering the global memory market, even one still catching up technologically, adds real supply to a market that is currently desperate for it. Whether that translates into lower prices for ordinary Zarvais within the next year or two, or whether the AI industry simply absorbs every additional chip CXMT can produce before it ever reaches a retail shelf, is one of the more overlooked storylines hiding inside all these trillion yuan valuation headlines. A few specific things are worth watching closely over the coming months. If you want to actually track where this story goes next, rather than just reading the headline once and forgetting about it, first, keep an eye on whether CXMT gets added to the Commerce Department's entity list in direct response to this IPO's massive new visibility. Given the Pentagon already flagged the company as military-linked just weeks before the listing, further restrictions are a very real possibility, and they would immediately reshape the calculus for any Western company, Apple very much included, considering CXMT as a long-term supplier rather than a short-term test. Second, watch the Stock Connect program closely. CXMT is reportedly on track for a review in late August that could make it eligible for Stock Connect inclusion as early as mid-September, opening the door for international investors sitting in Hong Kong to buy into the company directly for the very first time. That would mark a genuinely major turning point, dragging CXMT even further into the center of global capital markets, rather than allowing it to remain a purely domestic Chinese story that Western investors can safely ignore. And third, and most importantly for anyone actually tracking the broader AI chip war rather than just the stock price, watch whether CXMT can actually deliver working HBM3 memory at meaningful commercial scale before the end of this year. Because if it does, this story stops being about a single explosive IPO day and starts being about whether NVIDIA's last real structural advantage inside the Chinese market, superior memory-fed performance in large-scale AI training, quietly disappears over the following 18 months. 3 companies used to control the entire global supply of the memory that modern artificial intelligence depends on to function at all. As of this year, for the first time in decades, there may finally be a credible 4th name on that very short list. It is backed by the full weight of the Chinese state, freshly funded with $8.6 billion from the single largest oversubscription any recent listing has seen, and already being quietly tested by Apple, even as the Pentagon keeps its own separate list of exactly which Chinese companies it's worried about. The global chip war didn't just get another headline this month. It may have just gotten an entirely new front line, running straight through a mid-sized city in central China that almost nobody outside financial circles had ever heard of until 466% changed that in a single afternoon. Whether that front line ends up favoring Beijing or Washington over the next 2 years is still genuinely uncertain. But one thing is no longer in question. The 3-company monopoly that has quietly powered the entire AI boom is no longer guaranteed to stay a monopoly. And the company that just broke it wide open didn't do it with a new chip design or a technological breakthrough. It did it with a stock market debut that even its own bankers may not have fully seen coming.